this is something that just come to my attention looking at my own database recently. The younger investors who I talk to, which are by now most of the additions to the database in the last 5 years, are absolutely attracted to the gold thesis. They are absolutely open to participating in gold stocks. It's the people who have large inventories of gold stocks, many of which are junk, that feel hostility. Some of the paradigms need to change. For 50 years, people have invested in gold stocks because they thought the gold price was going to go up. They've looked for leverage to gold. The stocks that have the most leverage to gold are the companies with the higher costs, because as the gold price increases, their margin increases faster. So the gold investors have come to favor, ironically, investing in the worst companies. The new investors have a very different outlook. They are looking for good companies, irrespective of the commodity. So it's strange that the investors who have the least experience in the industry are at once the most favorably inclined and the most rational. This is the building block, the first building block of a bull market. Intelligent application of capital in a bad market is always, you'll remember the uranium business in 2022. The intelligent application of capital in a bad market is always square one for building a bull market. I feel over the 5-year time frame, very attractive. Not to the gold mining sector, which I think is a disaster, but to the high-quality companies, some of the high-quality companies that grab today.
In this insightful snippet from finance guru Rick Rule, we gain valuable perspective on the surprising resilience of the U.S. economy amidst rising interest rates. Despite concerns, housing starts and durable goods, sales haven't slowed as expected. Yet while equity markets, especially tech giants, thrive, wage growth remains a concern. Rick highlights a peculiar trend in gold investment. While traditional investors face skepticism due to past industry performance, newer investors, especially younger demographics, show a keen interest in gold stocks.
I had anticipated that the increase in interest rates that we've seen would have had a harder effect on the economy. I would have expected that housing starts to be slower. I would have expected durable goods sales to be lower. I am pleasantly surprised by the strength in the U.S. economy. It is true that some of that strength is focused, as an example, in the equities markets. The great big tech stocks, the world dominators, seem to be the ones that are catching most of the bids. But I'm also surprised by wage strength. I'm surprised by the employment statistics. I'm cognizant of the fact that many Americans are suffering, that the wages that people are being paid do not necessarily compensate them well for the increase in the prices of goods and services that they consume. So I'm not suggesting that the economic strength that I see in the United States in particular has benefited everyone. But I am still surprised by the strength in the U.S. economy after those interest rate increases. People have been afraid for a long time about the possibility of recession. Were we to have a recession with relatively high interest rates, there is a chance that you could have a liquidity squeeze, like 2008. People are nervous about that. The consequence of them being nervous is that there's $6 trillion cash in money market funds. And some of that cash now is finding its way back into the market. Your listeners need to be aware of the fact that the equity market strength is very concentrated strength. If you look at the S&P 500, which has done well, there are something like 10 stocks beyond the Magnificent Seven that have driven that market. So the market breadth, for the equity market breadth is lousy. And the bond market is still, the long bond market is still lousy. It's important to note that a lot of the strength is concentrated. And people do need to be aware of that. I have not seen as great a disconnect between the gold price and the gold stocks in my career since the early part of the 70s. I have also not seen as much investor hostility to gold stocks since 1970. Nor have I seen gold stocks at these valuation levels relative to book or relative to free cash flow. So the industry's suggestion that the market for gold stocks is at record lows is accurate. Now, I would argue, unfortunately, that the mining industry deserves that. The investors' expectation have been set by 50 years of poor corporate performance in the gold business. The gold industry needs to own the fact that in the decade 2000 to 2010, when the gold price went up sevenfold, free cash flow per share in the Philadelphia Gold and Silver Index fell. It took real talent to generate declining free cash flow in the face of the sevenfold increase in your price. And the juniors actually are worse. What investors need to understand is that although I think if you buy the sector, you go broke, if you buy good individual companies, you get rich. There are a few performers, both among the majors and among the juniors, that deliver so much value and so much performance that they add legitimacy to the whole sector. And I think it's that dichotomy people need to come to understand. I think, too, if you're going to participate in the sector, we learned, you and I, as an example, that you participate in uranium when nobody wants to be there. And the fact that nobody wants to be in gold is its greatest attribute. I'm understanding that this is anecdotal. I'm not a social scientist. I do maintain a database of 80,000 investors. And what I notice is that the younger investors, the non-U.S. investors, and interestingly, the younger female investors, have no inherent hostility to gold because they haven't experienced the industry. It's the gold bugs. It's the people that have 30 or 40 years of experience in gold that are feeling hostile towards it. And this is something that just come to my attention looking at my own database recently. The younger investors who I talk to, which are by now most of the additions to the database in the last 5 years, are absolutely attracted to the gold thesis. They are absolutely open to participating in gold stocks. It's the people who have large inventories of gold stocks, many of which are junk, that feel hostility. Some of the paradigms need to change. For 50 years, people have invested in gold stocks because they thought the gold price was going to go up. They've looked for leverage to gold. The stocks that have the most leverage to gold are the companies with the higher costs, because as the gold price increases, their margin increases faster. So the gold investors have come to favor, ironically, investing in the worst companies. The new investors have a very different outlook. They are looking for good companies, irrespective of the commodity. So it's strange that the investors who have the least experience in the industry are at once the most favorably inclined and the most rational. This is the building block, the first building block of a bull market. Intelligent application of capital in a bad market is always, you'll remember the uranium business in 2022. The intelligent application of capital in a bad market is always square one for building a bull market. I feel over the 5-year time frame, very attractive. Not to the gold mining sector, which I think is a disaster, but to the high-quality companies, some of the high-quality companies that grab it today.
In the next discussion, Rick Rule offers intriguing insights into the potential triggers for a gold market surge, emphasizing the exhaustion of sellers as a crucial factor. He predicts a potential gap-up in gold stocks once momentum is established. With precious metals currently accounting for less than 0.5% of total savings and investment assets in the US, Rule highlights the significant room for growth in this sector. While the timeline for this shift remains uncertain, Rule stresses the profound impact of a gold bull market and the potential for substantial returns, drawing parallels to his early investment in uranium. He also critiques the performance of the gold mining industry over the past 5 decades, suggesting caution for pension funds until real reforms are enacted.
I think the trigger will surprise people. I think what will happen is that sellers would become exhausted. I think that's what's going to happen. The sellers will become exhausted, and the bids won't get filled. When the momentum gets established in the gold stocks, what I think that you'll see, likely, and I don't want to give your baby too much hope, but I think it'll gap up. That's what's happened in past markets. When you exhaust the sellers, it gaps up. Here's an interesting statistic for you, Shaw. Maybe I've used it before. precious metals and precious metals equities comprise less than 0.5% of the total savings and investment assets in the United States. Less than 0.5%. The 4-decade mean is 2%. If the market share of precious metals and precious metals-related assets returns to mean, demand for them increases fourfold. And that's what I think happens. Does it happen in 2 years, 3 years, 4 years? I don't know. I have no idea. What I do know is that a gold bull market, a gold equity bull market, is such a profound event that if you're 2 years early, like I was on uranium, it doesn't matter. The amount of money you make, particularly given the fairly low level of risk, at absolute risk, that you experience deploying capital now, is silly. I think that the Canadian pension plans owe a duty to the pensioners. The performance of the gold mining industry over the last 50 years would suggest that until real reforms have taken place in the industry, that the pension fund should avoid it like the plague. The idea that pensioners have some duty to support the Canadian economy with their hard-earned pension dollars is exactly wrong. The pension managers have the duty to the pensioners, not to society at large. I think that was an ill-founded, and in fact, I think it was a harmful statement. I believe it was well-intentioned. I think the gold mining industry needs to ask itself why it's perpetually short of capital. Had it made money for investors in the past, it wouldn't need to come back and pass the hat. It's sort of like 4-8. Send new money, old money all gone. But that doesn't seem to me, personally, to be a prescription for a sector that deserves a lot of pension funds.
As we conclude today's discussion with Rick Rule, let's recap the key takeaways. Firstly, we've witnessed a surprising resilience in the U.S. economy, despite anticipated challenges from rising interest rates. Rick highlights the concentrated strength in equity markets, particularly in tech stocks, while cautioning about market breadth and the lingering weaknesses in the bond market. Additionally, he sheds light on the intriguing dynamics within the gold sector, emphasizing the potential for a paradigm shift in investment strategies, especially among newer investors. Furthermore, Rick shares insights into potential triggers for a surge in the gold market, stressing the importance of intelligent capital allocation and the need for real reforms in the gold mining industry. We've covered a lot of ground today, and we hope you found this discussion valuable. Don't forget to subscribe to our channel, like this video, and share your thoughts in the comments below.